Hello and welcome to Book Club and this audiobook summary of The Psychology of Money by Morgan Housel. Have you ever wondered why smart people sometimes make terrible financial decisions? Or why your neighbor with no finance background seems to build wealth effortlessly? The answers might surprise you. Over the next 15 minutes, I'll walk you through the most important lessons from this fascinating book, insights that could transform the way you think about money, saving, investing, and financial success. Morgan Housel's central argument is brilliant in its simplicity. Managing money successfully isn't necessarily about what you know or how smart you are. It's about how you behave. And behavior is hard to teach, even to really smart people. So let's dive in and explore why doing well with money has little to do with your intelligence quotient and everything to do with your behavior quotient. By the end of this summary, you'll understand why your financial decisions are more emotional than you might think, and how to make better choices moving forward. Are you ready? Let's begin. Chapter 1, No One's Crazy. We all make financial decisions that might seem irrational to others, but here's the surprising truth. We're not crazy. Our unique experiences shape our relationship with money in profound ways. Housel explains that people's perspectives on money are heavily influenced by the economic conditions they experienced in their formative years. Someone who grew up during the Great Depression likely views money very differently from someone who came of age during the booming 1990s. Think about it. Your grandparents who survived economic hardship might seem absurdly frugal to you, but their behavior makes perfect sense given their experiences. The crucial takeaway is this. We all have different views about money because we've lived through different experiences. There is no single right way to think about money, risk, reward, and financial decisions. So next time you feel frustrated by someone else's financial choices, or they question yours, remember you're viewing money through the lens of your unique experiences, and that's completely normal. Chapter 2, Luck and Risk. Have you ever noticed how we tend to attribute our successes to skill, but our failures to bad luck? In this chapter, Housel challenges us to recognize the enormous role that luck and risk play in our financial outcomes. Bill Gates attended one of the only high schools in the country with a computer. Warren Buffett was born in the United States during an economic boom. These factors weren't skills. They were strokes of luck that positioned these individuals for success. The book makes this powerful point. Acknowledging luck doesn't diminish your achievements. Instead, it promotes humility and helps you avoid overconfidence in your investment decisions. Similarly, recognizing that risk is always present, even when things go well, can help you prepare for inevitable downturns. Just because your risky investment paid off doesn't mean it was a good decision. You might have just been lucky. The next time you evaluate your financial successes or failures, ask yourself, what role did luck or risk play in this outcome? This simple question can lead to much wiser financial thinking. Chapter 3, Never Enough. Have you ever achieved a financial goal only to immediately start chasing the next one? This chapter explores a dangerous financial trap, the inability to know when enough is enough. Housel shares stories of wealthy individuals who lost everything because they couldn't stop taking risks, even after achieving enormous success. The Bernie Madoffs and Rajat Guptas of the world had more money than they could ever spend, yet risked it all for just a bit more. The vital lesson here is that no amount of money will make you feel wealthy if you're constantly raising the goalposts. True wealth isn't measured by the dollar amount in your account. It's when you've reached your definition of enough. Ask yourself, what is my enough? Is it financial independence? A comfortable retirement? The ability to help your children? Once you define your enough, you can make smarter financial decisions and avoid the trap of endless accumulation. Chapter 4, Confounding Compounding. Albert Einstein reportedly called compound interest the eighth wonder of the world, and this chapter shows us why. The astonishing power of compound growth means that tails, the rare, extreme outcomes, drive everything. Warren Buffett started investing when he was 10 years old, and today he's worth tens of billions. But had he started investing in his 30s, even with the same skill, his wealth would be a fraction of what it is now. The most important financial lesson you can learn is this. Good investing isn't about earning the highest returns. It's about earning pretty good returns for the longest period possible. Time is the superpower of compounding. A modest 7% return sustained over decades will outperform even the most brilliant investor who tries to time the market over shorter periods. So start now, no matter how small. Your time horizon is your greatest advantage when it comes to building wealth. Chapter 5, Getting Wealthy vs. Staying Wealthy. Did you know that getting rich and staying rich require completely different skills? This chapter explains why. Getting wealthy often involves taking risks, being optimistic, and putting yourself out there. But staying wealthy requires humility, fear, and paranoia. Why? Because while getting rich often depends on one big thing going right, staying rich depends on avoiding many things going wrong. Housel introduces us to the brilliant formula. Wealth equals income plus savings times investment returns minus ego plus stress. The survival mindset is crucial. Financial success is not just about making good investments. It's about surviving long enough for your good decisions to compound over time. Remember this. You don't need to grow your wealth at the maximum rate to be successful. Your goal should be to grow it at a reasonable rate that you can sustain for the longest time possible. Chapter 6, Tails You Win. In investing, we tend to focus on averages. The average annual return of the stock market, for example. But this chapter reveals a surprising truth. In investing, the average is misleading. Most individual investments will fail or barely break even. The majority of an investor's lifetime returns come from a small handful of investments that perform extraordinarily well. This explains why most venture capital investments lose money, yet venture capital as a whole generates excellent returns. It's about the tail events, those rare extreme outcomes that make all the difference. The powerful implication is that you don't need to be right all the time to succeed in investing. You just need to be mostly not stupid and occasionally very right. This is why broad diversification is so important. It increases your chances of capturing those rare winners that drive overall returns. Chapter 7, Freedom. What's the highest form of wealth? According to Housel, it's not about fancy cars or luxury vacations. It's about freedom, the ability to control your own time. Money's greatest value isn't in what it can buy. It's in the options it gives you, the flexibility to make choices based on what you want to do rather than what you have to do. Think about it this way. When you can turn down opportunities that don't interest you, say no to toxic work environments, or walk away from stressful situations, that's when you're truly wealthy. The book makes this profound observation. People will trade money for happiness, but they'll almost never trade freedom for more money. This suggests that when we pursue wealth, what we're really after is autonomy and independence. So as you make financial decisions, ask yourself, is this bringing me closer to or further from freedom? This question can guide you toward true wealth. Chapter 8, Man in the Car Paradox. Have you ever admired someone driving an expensive car? This chapter explores the man in the car paradox. The idea that when you see someone driving a nice car, you likely admire the car, not the person inside it. This highlights a fundamental misunderstanding about wealth. We think that displaying wealth will bring admiration and respect, but what it often brings is a hollow form of attention. Housel argues that using money to buy things might lead to temporary happiness, but using money to buy control over your time leads to sustainable happiness. The crucial insight is that wealth should be measured not by the money in your bank account or the car in your driveway, but by the freedom you have to live life on your own terms. Remember, no one is impressed with your possessions as much as you are. The status that comes from material goods is fleeting, but the contentment that comes from having control over your time is lasting. Chapter 9. Wealth is what you don't see. We often judge wealth by what we can observe: beautiful homes, luxury cars, designer clothes. But this chapter reveals a counterintuitive truth. True wealth is actually what you don't see. Wealth is the money not spent. It's financial assets that haven't been converted into visible goods. When someone spends lavishly, they're displaying their past wealth, but possibly compromising their future wealth. This creates a dangerous illusion. We tend to gauge financial success by spending habits, but spending is often the opposite of wealth building. The people who look wealthy and the people who are wealthy are frequently different groups. The powerful lesson here is to focus on building hidden wealth, investments, savings, and financial security that might not be visible to others, but provide you with options and freedom in the future. Remember, spending money on status signals might feel good in the moment, but it's the wealth that nobody sees that brings long-term financial independence. Chapter 10. Save money. Why should you save money? This chapter explains that saving isn't just about preparing for specific expenses. It's about preparing for life's inevitable surprises. Housel makes this critical point. Saving money gives you options and flexibility that are invaluable when life takes unexpected turns. It's not just about having an emergency fund, it's about creating opportunity capital. The book suggests aiming to save 20% or more of your income, but acknowledges that any amount of savings creates some financial flexibility. The most important reason to save is this: your future self will face expenses, emergencies, and opportunities that your current self cannot even imagine. When you save, you're giving your future self options. And here's the psychological benefit. Saving reduces stress and increases happiness. It's not just about being able to buy things later. It's about sleeping well tonight, knowing you have a buffer against life's uncertainties. Chapter 11. Reasonable greater than rational. What's better than making rational financial decisions? Making reasonable ones. This chapter challenges the idea that we should aim for mathematically optimal financial choices. Instead, Housel argues that we should make choices we can stick with, even if they're not theoretically perfect. The brilliant insight here is that a reasonable financial plan that you can maintain for decades will outperform a rational plan that you abandon during difficult times. For example, keeping some cash savings might not be mathematically rational when inflation erodes its value. But if having that cash helps you sleep at night and prevents you from making panic decisions during market downturns, it's perfectly reasonable. The lesson? Don't strive for financial decisions that look good on paper. Focus on strategies that work with your psychology rather than against it. Chapter 12. Surprise. History is filled with events that nobody saw coming. This chapter argues that the most important economic events are those that couldn't have been predicted. World War I, the Great Depression, the dot-com bubble, the 2008 financial crisis. These weren't just surprising, they were shocks that reshaped the economic landscape. The powerful implication is that we should prepare for a future that will surprise us in ways we cannot imagine. This means building financial plans with room for error and maintaining humility about our ability to predict what's coming. Housel suggests thinking in terms of probabilities rather than certainties, and maintaining financial flexibility to adapt when the inevitable surprises occur. Remember, the future will not be like the past. Prepare for surprises by diversifying your investments, maintaining adequate savings, and staying adaptable in your financial planning. Chapter 13. Room for Error. How can you protect yourself from financial disaster? This chapter explains the concept of margin of safety. what Housel calls room for error. The vital principle here is to build financial systems that can withstand unexpected setbacks. This means avoiding excessive debt, maintaining emergency savings, and not risking what you need for what you merely want. Housel shares this crucial insight. You can be wrong half the time and still make a fortune, but you cannot be wrong once and go bankrupt. This asymmetry explains why having a buffer against failure is so important. The book recommends several practical strategies to create room for error. Save more than you think you need. Expect lower returns than historical averages. Plan for longer time horizons than you anticipate. Diversify your investments across different asset classes. Remember, the goal isn't to optimize every financial decision. It's to ensure your financial plan can survive even when things go wrong. Chapter 14. You'll change. What financial goals are you working toward right now? This chapter makes a startling observation. Your future self will likely have different goals, values, and priorities than your current self. We tend to underestimate how much will change in the future. The person you'll be in 10 or 20 years might want very different things than the person you are today. The profound implication is that rigid, inflexible financial plans often fail, not because the math was wrong, but because our goals evolved. What seemed important in your 20s might seem irrelevant in your 40s. Housel suggests planning for your financial future with flexibility in mind. Rather than optimizing for specific outcomes, optimize for options that will serve you well, regardless of how your values change. The key takeaway? Make financial decisions that maintain your ability to pivot when your goals inevitably shift. Build wealth in ways that maximize your future freedom of choice. Chapter 15. Nothing's free. Why do we repeatedly fall for financial bubbles? This chapter explains that every investment has a price, not necessarily in dollars, but in the form of volatility, stress, uncertainty, or complexity. The essential insight is that higher returns always come with higher costs. These costs might be emotional rather than financial, but they're real and unavoidable. Housel makes this powerful point. The volatility of the stock market isn't a bug, it's a feature. It's the price we pay for higher returns. If stocks didn't occasionally crash, they wouldn't offer returns superior to safer assets. Understanding this helps us make better investment decisions. Instead of chasing the impossible dream of high returns without risk, we can ask more productive questions. What kind of pain am I willing to endure? And what price am I willing to pay? Remember, nothing worth having in the financial world comes free. Accepting this truth leads to more realistic expectations and better long-term results. Chapter 16. You and Me. Why do we often misunderstand each other when it comes to money? This chapter explores how individual perspectives create communication barriers in the financial world. We all view money through our personal lenses, shaped by our unique experiences. What seems obvious to you might be foreign to someone else, not because they're wrong, but because they're coming from a different starting point. The critical lesson is to recognize that people make financial decisions based on their own histories, values, and goals, not yours. When we fail to acknowledge this, we end up talking past each other. This applies to everything from market forecasts to personal finance advice. What works for one person might be disastrous for another, not because the advice is wrong, but because contexts differ. Remember, there is no single right answer in personal finance. The best financial strategy is the one that works for your specific situation and that you can stick with over time. Chapter 17. The Seduction of Pessimism. Have you noticed how financial pessimists often sound smarter than optimists? This chapter explains why we're naturally drawn to negative financial predictions. Pessimism sounds intellectually compelling in a way that optimism doesn't. Warning someone about potential dangers feels more responsible than telling them everything will work out fine. The fascinating insight is that while pessimism gets our attention quickly, optimism tends to be right more often over the long run. Throughout history, despite setbacks and crashes, economies and markets have generally moved upward. Housel shares this powerful perspective. Progress happens too slowly to notice, but setbacks happen too quickly to ignore. This asymmetry creates a persistent pessimism bias in how we think about money and investing. The takeaway? Be wary of financial doomsayers. Acknowledging risks is important, but so is recognizing that long-term optimism has been the correct stance throughout economic history. Chapter 18, When You'll Believe Anything. Why do people fall for financial scams or buy into questionable investment theories? This chapter explains that in times of stress or uncertainty, our critical thinking abilities can deteriorate. When we're desperate for answers during market crashes, recessions, or personal financial crises, we become vulnerable to stories that promise explanation or solutions, even when those stories don't make sense. The crucial insight is that the more we want something to be true, the more likely we are to believe it without proper evidence. This applies to get-rich-quick schemes as well as to complex economic theories. Housel suggests maintaining intellectual humility and being especially vigilant during times of financial stress. That's when you're most likely to abandon good judgment in favor of comforting narratives. Remember, the most dangerous financial ideas are those that tell you exactly what you want to hear, especially during uncertain times. Chapter 19, All Together. Now this chapter synthesizes the book's key lessons into a coherent philosophy of money. It presents Housel's personal approach to money, which emphasizes simplicity, sustainability, and risk management. The essential elements of this approach include: save a reasonable percentage of income, even if it's not mathematically optimal. Accept that you'll make mistakes and leave room for error. Avoid extreme ends of the risk spectrum. Define specific financial goals. Aim for just pretty good returns sustained over a long time. Use money to gain control over your time. The powerful message is that financial success doesn't require extraordinary knowledge or intelligence. It requires patience, discipline, and an understanding of your own psychology. Housel's approach isn't about maximizing every financial decision. It's about creating a system that works reliably over decades without demanding superhuman willpower or foresight. Chapter 20, Confessions. In the final chapter, Housel shares personal reflections on his own relationship with money. He acknowledges that everyone's situation is different, and what works for him might not work for others. The authentic approach in this chapter reinforces a central theme of the book. There is no one-size-fits-all approach to money. We each need to find strategies that align with our unique values, goals, and personalities. Housel emphasizes that he doesn't have all the answers, but he's found an approach that works for his family, one that balances reasonable growth with peace of mind. This humble conclusion reminds us that even financial experts are on their own learning journeys. The goal isn't perfect financial optimization. It's finding a path that brings both material comfort and emotional well-being. Conclusion. Thank you for listening to this summary of The Psychology of Money by Morgan Housel. We've covered a lot of ground, from understanding how our personal experiences shape our financial views, to recognizing the critical importance of behavior over knowledge when it comes to managing money. If there's one overarching message to take away, it's this: successful money management isn't about complex strategies or brilliant insights. It's about understanding your own psychology and creating systems that work with your human nature rather than against it. Remember that getting the big things right matters more than optimizing every decision. Save consistently, create room for error, take reasonable risks, be patient, and above all, use money to gain control over your time, the truest form of wealth. I hope this summary has given you valuable insights that you can apply to your own financial journey. The psychology of money is fascinating because it touches on so many aspects of human behavior, our hopes, fears, biases, and dreams. By understanding these psychological factors, you'll be better equipped to make financial decisions that serve your true goals, whatever they may be. Until next time, here's to making wiser financial choices based on how we actually behave, not just what we know.